Hello, everybody, and welcome to Access to Capital and how to get terms sheet in today's climate. In today's discussion, they'll touch upon what they're looking for in lifestyle startups now and how you can stand out from pitch to diligence to final term sheet. Today's webinar is brought to you by University Lab Partners. My name is Teresa Fry. I'm the events coordinator at ULP. As we get started, I'd like to take a moment to introduce you to ULP.
Hi, I'm Karen Cook, Executive Director at University Lab Partners. University Lab Partners really serves three critical roles here in Orange County. First and foremost, we support life science innovators and entrepreneurs by providing wet lab space and critical infrastructure. Second, we serve as a landing ground for life science innovation. We provide networking and educational opportunities so life science innovators really have a place to call home. But most importantly, University Lab Partners serves as a catalyst in this region for workforce development activities in the life science space here. We truly believe as our companies are creating great jobs, we need to serve as an active agent to develop that talent pipeline for this sector.
What makes our hands-on laboratory experiences unique is the fact that they are led by our life science innovators that are actually here working within our space. These instructors bring their real-world experience and applications into the classroom as the students are using industry-standard techniques and equipment.
With our expansion here in the Orange County community, we look to serve more innovators and students all across Orange County.
As Karen previously mentioned, ULP University Lab Partners is a nonprofit premier wet lab media tech incubator located in the UCI Research Park in Irvine, California. We provide researchers with over 22,000 square feet of scientific resources, contribute to the acceleration of innovation in Orange County. Our next slide is our benefits. We talk about encompassing flexible lab and office space, state-of-the-art scientific equipment, access to UCI's technical core resources, and on-site experts and residents. And then at ULP, we provide extensive support to our commercialization endeavors throughout a wide array of resources and activities. Don't forget to connect with us on various platforms as you see here, and we always appreciate hearing from you. Just a little housekeeping before we get started. Everyone is muted and during the webinar, and there is a Q&A at the end of the presentation, but feel free to ask questions during the webinar by writing them in the chat box. We may not get to everybody's questions, but we'll do our best. Most importantly, the recorded presentation will be shared with you in a follow-up email. And today's webinar is hosted by ULP, like I mentioned before, and I would like to introduce our webinar presentators, Parissa, and I apologize if I say your name, Kazapur and Kelly Kahara. Parissa is president of the Tech Coast Angels, an executive leader in the life science, medical diagnostic, and in vitro diagnostic industries, where she has developed a progressive career built on accomplishments in change management, strategic operations leadership, product innovation, and bottom line performance. Kelly is the director of life science tools and diagnostics at General Inception, a venture studio model based in Palo Alto. General Inception has a portfolio of 40+ early startups in tools, therapeutics, and engineered biology. Kelly has completed a PhD at the University of Chicago in biomedical sciences and has a postdoc in diabetes research at UCSF. So thank you very much for being here, Parissa and Kelly, and I'd like to present and turn this presentation over to you.
Great, thank you. Thank you for the introduction. Hello, everyone, and thank you so much for the opportunity to present to the team today. So I think for this segment, we're presenting sort of angel perspective and VC. I think in many cases, they're very similar. And then sometimes we come in at different stage of the startup. And so wanted to share a little bit about our investment thesis. All right. So hopefully everybody can see. Oh. hopefully you can. All right. Okay. So I thought I start the presentation today a little bit about sort of pitch deck, your slide deck, but with a different perspective, right? There is so much information out there about what should a pitch deck include, what it shouldn't, and the flow and the templates. But I thought I share with you, at least from an angel perspective, what they want to hear in a pitch deck, right? What are they looking for? What type of information they're looking for in your pitch deck? So this is in no particular order of importance, just sort of going through key topics. And also remember that especially when you're pitching to angel groups, every group is a little bit different. Some of them only have a 5-minute pitch. They want to hear a little bit about you to decide, is it a go or a no-go, to go into more details. Some give you 10, 15 minutes. So it's really about how you align your storyboard and the key messages you want to share with the investors. So, typically, of course, angel groups come in early part of the startup, right? We're coming at pre-seed, seed stage. So it's a lot about the team, right? The investor want to make sure that the team has relevant industry experience. The team actually their skill complement each other. It's not scientific heavy or business heavy. There's a balance between everything and ability for the team to execute. They really look at see what accomplishments the team has had prior to this startup, and then once joining this startup, how they've been able to contribute, and really about the commitment to the startup and willing to see it to succeed. Also, what is the value proposition of the startup? Are you really solving a problem, a real problem, right? What is your target? And what's differentiated from your solution versus what's currently in the market? And also sometimes it's probably tougher for a healthcare startup, but to see some kind of attraction evidence. Have you done some kind of customer interviews to really understand what are the key needs and how you're addressing those? Investors want to understand the business model. Is it a potential for growth and profitability? What does that customer acquisition process and cost looks like, right? And has the team really thought about the path to revenue generation? What does that look like and the timeline for that? Investors want to see the potential market opportunity, right? What is that addressable market? I know sometimes, we see these, 20 billion, TAMs, and everybody thinks, okay, but I definitely encourage you to really think about when you're presenting what truly that addressable market is, because investors will do a deeper dive if they decide to learn more about your company, and you really want to be transparent as far as what that opportunity looks like. And also, is it a large market or is it a niche or emerging trend, and how you're going to execute to achieve that opportunity? In addition, of course, competitive landscape is very important, really understanding who are your key competitors. Some are already in the market, but also, again, remember that you are presenting to savvy investors. So they see a lot of pitches in different segments. So they know what's coming or who is already starting certain startups. So making sure that not only you talk about existing competitors in the market, and if you're aware of some of the other startups, make sure you point them out and what's, again, the competitive advantage of your startup, and what is your defensible moat, right? Sometimes it's through intellectual property, and then sometimes it's really the network and the team or your path to market. Financial projection, while sometimes there is not enough time during an initial pitch to really do a deeper dive into the financial projection, but my recommendation is that if you have a slide, and I'm sure, in sort of continuing progress, if the investors want to hear more about your company, they're going to do a deeper dive into your financial projection. So make sure you've really done a bottoms up While I understand financial projection is aspirational, right? This is what you want to achieve, but it needs to be on solid ground and it needs to be achievable, right? Because understand your numbers and understand how you're going to get to those numbers. Because once they start asking you questions and how you get to those numbers, and if you really don't have solid answers, right, that's when things can fall apart. Also, investors want to see how you've used your capital so far, right? Are you frugal? Are you spending on what must have rather than nice to have? Are you spending, and how are you going to deploy the capital that you're raising? Is it just going to cover salaries, or how is it going to get you to the next critical milestone? Also, what is achievable, right? Based on what you're raising, what's coming up in short and long-term milestones, right? They want to see progress towards key milestones, because that's where the value of your company will go up, right? These are the things you're going to execute until you get your FDA clearance, or these are the things you're going to execute until you start your initial go-to-market activities. So making sure that what you've achieved so far with the capital you've had, and what's upcoming milestones short term, and then what are the long-term milestones that you plan to achieve. Investors, of course, want to see the exit potential, right? What that looks like. It's good to include example of a successful exit, but again, make sure you're realistic. So don't compare if you plan is to exit, say, after receiving FDA clearance and sort of looking for a strategic to acquire you, you cannot compare your exit potential with a company that exited or was acquired when they were generating, say, $100 million of revenue, right? That value doesn't compare. So again, be realistic, because again, investors, they know their segment and they will question you about that. Also, typically for angel investor, I think is a little bit different than VCs. They're looking for a little bit of a shorter time horizon, right? Angel investors are looking for 5 to 7 year exit. Realistically, it's typically 7 to 10, but at least for them, how they question and how they want to see the team progress is around 5 to 7 year time horizon. Also, typical things, your legal structure, intellectual property, right? Understanding that, and then of course, compliance with the regs. Valuation and deal terms. If you have 1 minute to pitch, you have 5 minutes to pitch, you have 15 minutes to pitch, make sure you have a specific slide about your deal terms, right? Investors want to understand what's your valuation, what are your key deal terms, what's the minimum investment required. So make sure that you have that. And of course, they're looking for investor friendly deal terms, right? Is it a preferred stock? They want to have pro rata rights and anti-dilution incentive. So these are the things investors look for. However, make sure always that you have a slide dedicated to deal terms and how you're going to deploy the funds that you're raising in that current round. That's almost always a must-have. And then others, things that could come up in a due diligence, but also company culture, values. And then it's about the team I talked about initially, but also sometimes, of course, startups, you don't have too much capital to deploy on headcounts. But the question is, who are your advisors? What is their industry experience? Again, not only they want to see the diversity in the team as far as knowledge and expertise, they also want to see the same thing for your advisors and how you're really utilizing their expertise. Because especially as an early startup, you probably are tapping into your advisors because of the limited number of employees you have. And then how they can connect you to the potential market, partners, customers, and other investors, of course. And then when it comes specifically to healthcare industry, right? So angel investors typically want to make sure that they come in typically when at least at minimum, there is a prototype built. Not always, but typical. There is some pilot study validation done. If it's a therapeutic, at minimum, there are some animal studies that have been completed. And typically non-therapeutics, they want to make sure that once they invest, there is at least commercialization within the 2-year time horizon. There has been some customer validation and adoption studies done. And then what is your business model, how you plan to generate revenue and potential exit opportunity, which I mentioned. Again, does it solve a real problem, or is it a me too? Are you just going in at a cheaper cost, or you really differentiated and you can differentiate yourself from the competition and what's out there? And can the business truly scale into 20 million within 4 to 5 years of conception, right? We talked about the management team. Angel investors typically like to see more than 1 or 2 members, right? Because it's a lot to execute and they want to make sure that the startup has the resources to achieve these initial but critical milestones. And then, of course, the CEO and the founders have the required domain expertise. I always put non-dilutive funding. It's not a must-have, but it's a critical aspect. I think especially for angel investors, because they come in early, having a non-dilutive funding is really validates the technology, gives a good cap table because there are not too many investors up front, right? Because this really doesn't dilute things, but also allows the team to accomplish a lot and execute on some of the initial but critical milestone with a non-dilutive funding to get the company to a good stage for future rounds. All right, so with that, I want to sort of switch back into who are typical angel investors. I think typically they're entrepreneurs, founders, CEOs, executives, and some of them are sort of managing partners of venture companies. And not only they have that, they join an angel group. They could be individual or they could be part of an angel network. There are many angel networks across US, so you become a member and utilize that membership expertise to assess possible investment. They have deep understanding of the startup landscape because many of them were founders that successfully exited their company. They're savvy investors with a strong network and tied to angel syndication network. And I think that's another value where if a group likes a startup and they really see a value, what they can do is utilize their existing angel network to introduce the startup to other angel groups, right? Or have it become a syndicated startup and raise fund and help raise fund for that particular company. They want to make sure the company survives, right? They came in early, they want to see it to the end. And most of them, just given their background and connection, they're willing to provide guidance, mentor, or put the sort of CEO or founders in touch with, expertise that they need throughout their cycle. And also willing to make additional funding, right, in future rounds. And typically they come in at pre-seed seed investment, not only through a fund. Nowadays, most angel groups have a fund where members individually contribute to that fund, and that fund makes an investment in a particular startup. And then in addition to that, they are willing to write individual checks if they really like a startup. And I mentioned that they're willing to invest in follow-up rounds. The approach, again, different for different angel groups, but typically you apply online. There's typically a pre-screen process. So a subset of the membership assesses the application, that does it meet certain guidelines or certain checklists for them to come to present to subgroup of the membership at a pre-screening. And then if the membership feels that, yeah, after hearing the initial pitch, yes, there is enough there that we want to hear more, then they invite the company to come and present to the larger cohort members. And then if there is enough vote, positive vote and interest, then the startup goes into a due diligence. The angel group forms a deal team that supports the entire due diligence process. Typically, it's the same checklist, but it's a different degree of evaluation as they assess a startup, whether it's pre-screen, screen, and of course, due diligence. Typically, once a startup is going into due diligence, right? So they've received enough vote and interest. There is follow-up with a questionnaire with different segments, right? About the team, about the technology, about the IP, operation, manufacturing, that the team has to fill out. And then there are additional documents that are requested. I've listed some of those here. My recommendation on this one is once you start raising, right? Now you're ready, you've achieved the critical milestone, you're raising your first round or your next round, make sure that you have created a deal room with key documents ready so that if there is an interest, right, you're not spending too much time prepping and putting these documents together, right? And of course, it really depends on the stage of your company, but typically these are typical documents or information that is requested by these angel groups as they want to go through the due diligence process. And there's a follow-up, you know, they set up meetings and each meeting goes through a section of the questionnaire with accompanying documents and information that they're asking from you. And then as far as investment goes, typically when you apply to an angel group and if they decided to invest in your startup, average investment from their fund, as I mentioned, because there is fund and sort of individual checks, average is somewhere between 100 to 300K. Some angel groups write larger checks, and there are some that might write a smaller check, you know, maybe around 50K. And then typically individual checks, of course, it depends on the startup's minimum investment requirement. My recommendation is always don't go above 25K. I know you don't want to have a busy cap table, but you know, if you have a minimum investment of 10 to 25K, that's the opportunity for individual investors also to write a separate check if they really like a investment. Typical post-money value, angel groups, 5 to 10. I know that seems very low for a healthcare startup, but I mean, they do tend to look at something around 15 or 20, but really there needs to be a significant traction or something special. But typically I would say it's a below 10 to 15 million valuation. And then of course they're looking for, you know, 8 to 20x exit within the 5 to 7 year time frame, as I mentioned before. Also, you know, it's a two-way street. I always recommend the startups, right? Really do your homework and understand the group's investment philosophy and how they can help you achieve your goals. Where are they in the fund cycle? So ask the question, you know, how much of your fund is left, right? Are you starting to raise? How much have you deployed? Ask them if they're willing to lead around. And also, you can ask to talk to their portfolio companies, at least talk to one or two. I think most angel groups should let you do that. There should be no issues with that. And then, of course, what they can offer outside the capital. Again, they're all very well-connected investors. They have a strong network, not only to capital, but also to expertise that they can help you. And then, of course, understand their due diligence process before you start to make sure that you understand their expectations so that you can achieve that. The more prepared you are, right, the better impression you put and make that, you're prepared to go through the process. And then I'm just closing it, but as a CEO, I always share that with the CEOs, right? You own the big picture, right? You develop the mission and the vision for your company. You define the competitive advantage of your startup and how you can bring value to your customers and differentiate your company. And then defining your targets, right? How you're going to achieve the market potential of your company. So in essence, you're establishing a compelling value to rally investors and for them to invest in your company. With that, I'm also aware of the time, so I'm going to pause and turn it to Kelly. Thank you.
Thank you, Parisa. Really fantastic presentation, wonderful overlap with what I'm going to share with you as well. Let me bring up my presentation. Okay. Sorry, there we go. Okay. So that was from an angel investor's perspective. I want to tell you a little bit about General Inception and what we do. We're a company builder / venture studio model, and kind of go through what that is. And then a lot of overlap with Parisa in terms of what we look for in diligence, and then specifically how you can stand out during these difficult economic times for fundraising. Okay, this is just the topic for today. So again, really want to touch upon what we're looking for in life science startups when we do our diligence process, and then how you can stand out with your pitch through diligence to final term sheet. All right, so who is General Inception? What is a venture studio model? So we're a company, we invest off of our balance sheet. We've raised capital from venture capital firms in the life science tool space. And so what we do is company creation. About half of our portfolio is from founders from universities where they have great ideas, great IP, but maybe not the ability to spend all of their time as, building a startup. And so the major difference between a venture studio model versus an incubator or an accelerator or a founder that has just made a startup on their own is that we have a team of executives that we partner with each one of the companies. And we are co-founders, we're employees, we're partners. You can call us up in the middle of the night. We think of ourselves as co-founders, and really what we want to do is bring executive resources to early stage startups, not just advisors, but again, really heavy-handed in order to help build the company during the pre-seed stage. So our investments are at the pre-seed stage and with a keen eye of getting funding through either our venture capital network or angel networks or other capital vehicles. We are a life science firm started by Paul Conley, who's our CEO. He's really big in the life science tools space. So about half of our team is in the life science tools and diagnostics vertical, which is where I'm at. And then we also have a therapeutics vertical and an engineered biology vertical. This is a timeline of how we see company formation. So again, we're very early stage. The impetus for General Inception was one of Paul Conley's first investments was QuantaLife, which became Bio-Rad's Droplet Digital PCR. He met the founders at Lawrence Livermore. He helped them get connected to the VC community. But what he realized is that there are a lot of steps involved, and it's really hard to sort of go from great idea from a lab to that first institutional round of funding. And so he created General Inception to help during that stage. So we enter after an idea has usually been protected by IP. We evaluate the technology and then we do the company creation. Again, heavy-handed with the company management, helping to build that company. And then fundraising and growth. So this is where our investment from our partners, our venture capital partners, has really helped our companies get a leg up when they go out and try to raise capital, because we have a group of friendly member VCs. Ultimately, we like to get term sheets from anyone in the VC community, but our member VCs have already seen our companies. They are familiar with the founders. They're familiar with the technology. Oftentimes when we're doing diligence, we have a voice of VC. So we're very keen on what our venture capital community is looking for. A lot of times they have small side funds to invest just in general inception portfolio companies. So again, we're trying to really complete the ecosystem and offer services and help through this end-to-end process of getting to that big first raise. I think what's really unique about general inception is that when it comes to fundraising, we kind of have two perspectives. So I lead our sourcing and diligence team for the life science tools vertical. I see hundreds of pitches each year. We have our own diligence process, and we think about exactly what Parisa talked about, different aspects of the company and how it fits in terms of the big market and within the technology. And so that's how we decide which ones get started and become a general inception company. At the other end, though, we want our companies to raise capital within a 12 to 18 month span of time. And so we're constantly fundraising for our companies when they hit that point. Again, very heavy-handed, making introductions to the venture capital community, setting up those meetings, setting up the data room, and then putting ourselves out there to do the pitches with the founders. So we kind of have experience on both ends of going through the diligence process, both at an early stage and at a slightly later stage. Okay. We have grown. So we were started in 2020, right before the pandemic. We've now grown to also have a fund in Europe that we call the Igniter Fund. And we have started 44 companies in the last 4 years. We've had 10 successful graduations. And again, we're not just investing capital, although that is an important component, but our main value add is this investment of human resources, our member VC and investor network. Not only do we have that relationship with the venture capital community, but we have the relationship with strategics. So for therapeutics, large pharma, for biotech and tools, it would be the Thermos and Biorads of the world. To really help our companies get to that next stage. Okay. I talked about Paul Conley, who's our CEO and founder, and General Inception really is his baby. Started with Vikram Chaudhry, who is our COO, and then we built up the European team with Francois and Venkat. But the key here is that we raised capital from venture capitalists that are very keen on the life science tools and diagnostic space in particular. So examples are North Pond Ventures, Genoa, Paladin, Vertical Venture Partners, and Omics Ventures. So we're very close with our member VCs. Again, we're happy to get term sheets from anyone in the VC community, including angel groups, but we have a really special close relationship with our member VCs who are invested in general inception and really invested in our companies getting to the next level and being successful. Okay. And then just a snapshot of general inception. So 44 total companies, 10 graduations. Our average seed round has been around 6 million. And we've raised, our companies have gone on to raise 200 million in follow-on capital. And a schematic to kind of capture more of what I've just said. So again, we're going very upstream, usually we have great relationships with universities, incubators like University Lab Partners, and accelerator programs. We do a lot of pitch events. We're looking for companies that are in the pre-seed stage, but do have some IP. And then we do our own diligence process during the selection stage. Those companies incubate with us as we build them. And then they go out to the broader venture capital community, and we help them fundraise and get to that next level. All right. So what are we looking for when we look at those hundreds of pitches in life science startups, and how can you stand out? So there's a lot of overlap with what Carissa said should be in a pitch deck, which makes sense because you want everything that is in your pitch deck to be things that we care about when we're going to go through diligence. And we have two stages. We have soft diligence and deep diligence. And, you know, we're just looking in greater detail as we move through the process. This seems really obvious, but it starts with a problem statement and a solution statement. So what's the problem that you're trying to solve for? And then how can your technology help? At a very high level, we're looking at team, technology, and market. So for us, I think we have an unusual model in that team is slightly less important, and that's just because we're also bringing team to the table. And so we're built for founders that maybe don't have the experience or the executive know-how or the business acumen, maybe more scientific. And so we can support them with our fractional executive model. But obviously, team can also be a deal breaker if, you know, if we're not a good match. Technology, looking at the technology, what does it do? And then market. So then when we talk about technology, again, it seems obvious, but we're in venture, we're trying to make outsized returns. Because we invest at such an early stage, we're really banking on the 10x genomics of the world, the real big $100 million in revenue hits to really feedback, payback, put more capital on our balance sheet so that we have more capital to deploy. And so those types of technologies are usually ones that are going to make a big technological leap, not a small incremental step. And, you know, it's much easier to do that in life science tools than diagnostics. Diagnostics is slow and steady, and oftentimes we see a lot of things in the same space, like lateral flow assays. And, you know, there are firms and funds that will invest in those types of opportunities. But for us in our investment thesis and strategy, we really are looking for those big 10x events. Entrenched market versus new market. Again, you know, biomarkers in genomics. You have Grail, Gardens, Freenome, many players in the space. IP is very crowded. And so we're always looking for, you know, new market, like something that may not have existed, like single cell sequencing 10 years ago, but something where a technology can open up a new market that doesn't even exist. That would be our ultimate. And then obviously, you know, we'd like a big market versus a small market. At the same time, you know, if we believe in the technology and believe that it can open up a new market, that is what we're looking for. So that's how we kind of like really high level assess the opportunity. And then when we start getting into diligence, you know, this is where we're getting the nuts and bolts of IP. So we will read the patent, we'll look at the claims, and then as we go through deeper diligence, we work with an outside law firm that will go and do a deep dive and see what's a very light freedom to operate, just so we have like a clear picture of sort of what we're investing in and what sort of moat we have when it comes to the IP. Commercial viability, so it can be a fantastic cell science Nature paper, but if it doesn't have commercial legs to be a product, maybe it's a better licensing opportunity. What we're really looking for are platforms, product lines, something to really build out a standalone company. Again, there are other private equity firms or other models where they have licensing strategies and they can support that. But for us, we want to, build out companies. I talked about market differentiation, so how you stand out in the market. We're looking at the milestones that you've hit, how long the timeline will be, and what the capital journey, so how much money is required to get you to that exit. And then this VC alignment and strategic alignment is really important to us because we have this built into our network, and this is how we built our company by design. So again, we have our 5 member VCs and a family office, and we know what technologies they're looking for, what gets them excited. As we're starting to go into deeper diligence with companies through General Inception, we call it Voice of VC. We actually tap our member VCs to get their opinion about what they think about the space. Do they think it's exciting? Because again, we want to be really aligned with that next step, which is that first institutional round of funding. We also have those same relationships with strategics. No one can predict what the exit will be or if a strategic will buy you, but just having a sense of, oh, they're interested in organoids, or these people are interested in next generation proteomics technologies. It sort of helps us align with our investment strategy to align with like the broader community. And then, again, with these partnerships too, if our member VCs see things that are too early for them, they can pass them back to us. And, there's more time for us to help and incubate during that pre-seed stage. And at the same time, we see a lot of pitches if things are too late and they really don't need the resources that General Inception offers, or maybe they're looking to raise a larger round, we can pass them forward. And then deal turn alignment. So, if you're looking for 10 to 15 million Series A, it's just not the right stage for us. And, but again, we love to help people and put them in a better place than we met them. And so we're more than happy to pass them along if it makes sense and aligns. So how can you as a startup stand out? The main thing is just what's your key differentiator? It's amazing how that gets lost in pitches, and really just being able to articulate like why you are better than what is out there. Just keep that in mind. And then what your value proposition is. So what problem are you solving? What are you bringing to the table that doesn't exist? Okay. So then, what are we looking for during diligence in a difficult funding climate? It's taking slightly longer for our own companies to raise money because the money that the VCs are deploying, they're needing to do bridge rounds or sort of spend more of their capital supporting their portfolio companies, which means that they have less money to do new investments. And so for our companies, it's going to take them a longer time to get to that new investment stage. So we're slowing down our pipe. So I think everyone is feeling it. Our companies are feeling it. There's definitely a slowdown. So what stands out during this time? And so, we've shifted and we're now looking for companies that are later, have a good track record of execution. So, 4 years ago, if you had a great idea and venture capital money was flowing, you could get funding for a great idea. And now we're really, we need to see execution and traction. And so what do we mean by execution? We think about things in terms of the milestones that you've hit that are correlated with inflection points, which increase company valuation. So fundraising, prior fundraising from incubators, accelerator, friends and family, angels, and VCs, really good proof points that other people have done their homework, done some diligence, like the idea, there's some traction there. Grants and awards, again, SBIRs and SCTRs are fantastic when capital is hard to raise, but it's also another proof point to just show that, you know, you were competitive and were able to win the grant. And it means that our investment is going to go a lot further because you also have non-dilutive funding. We want you to shore up the core technology. That kind of goes back to this, you can't just have an idea anymore, but really making sure that you have data around that core technology and that it works. It can still be a breadboard, it can still be proof of concept stage, but you need data. And we still see a lot of pitches where it's just an idea, and some of them are fantastic ideas, but we need to see data now. So that's the next point, proof of concept data. And then really, you know, I think that early customer data, this used to be, again, at the pre-seed stage, something that we didn't expect at all. Maybe from our reagents only companies, certainly not from our instrumentation companies, but people are getting savvier with bootstrapping their company, and they're able to collect customer data earlier. And that is really meaningful to us to see that it's not just holed up in the lab and needs 2 years of development before it reaches a customer. As soon as it's working, get it into a customer's hands so that you can get customer data. I know I need to really hurry up here. Partnerships and letter of intents from strategics, early revenue, and then, you know, de-risk. What we're looking for is capital efficiency. So again, if you've raised some money, have you been very efficient? Have you made it really far with that money? What milestones have you hit? We're looking for things that take less money and less time. So before, if you had a, you know, early stage cancer diagnostic, that's great, but that's going to take a lot of capital and a lot of time in order to make an exit. We're looking for things that have a much shorter horizon. And then the use of non-dilutive funding. You know, it is a buyer's market, so we're looking for good deal terms. But at the end of the day, it's really this, you know, big idea, white space. What gets us excited is something that's going to be a huge hit if it pans out. So how can the startup stand out? This is my last point. You know, this is harder or easier said than done, but multiple term sheets and diligence, broad VC network. You know, what gives us FOMO is when you say that you're in diligence with a couple groups or that you have a couple term sheets. That's how you stand out. Awards mean something out of incubators and accelerators. You know, I could hear a pitch and then all of a sudden they say they won first prize at something, and it, you know, it gets me excited. The partnerships and letter of intents, early revenue, and again, just being later with a sales funnel. All right, so I will stop there. And we have about 10 minutes for Q&A.
Anybody has any questions, they can probably unmute and go ahead and just feel free to ask, or if you feel more comfortable in doing the chat, we'll be happy to answer questions there.
I think you have one raised.
May I? This is Fong. I'm a incoming CEO of Cerna Med Therapeutics, as well as Biotherapeutics. We are focusing on totally new technologies that are delivering RNA treating cancers. I never done it before. We do have a proof of concept study, including animal study, as well as overall survival in drug-resistant cancers, including triple negative cancer, which is no drug treatment that can reverse the overall survival. But I think based on the last few months that we meet with all the large pharma, as well as those are interested in, they said 2 new technology to evaluate, because even the leadership in the team, as well as there are leaders in the field of RNA, and including those 3 companies that worked previously, they're not able to crack that big nut using RNA treating cancer. So when we show the data, they don't even believe it. And how you convince investors that these are really remarkable platform that can change the whole way how we treat cancers, including those multiple different drug resistance and mutations, and safely deliver RNA. How you convince that even seasoned investor at a big biopharma are very surprised that little they know about the technologies, including microRNA and specific sRNA that using peptide conjugation to deliver outside and using gradable label chemical that can deliver directly to the tumors.
Yeah, I think, I immediately think of generalist versus specialist investors, and we get feedback when people pitch to us how knowledgeable we are in the tool space. Like, we're very specialized. Most of us have PhDs, and we're very technical, and so we love getting into the technical weeds. So I would say, if you could find investors that are experts in this space, and sometimes how I figure that out is if there are any competitors or like companies using similar technologies, and then you can look on PitchBook or Crunchbase and see who their investors are and start to build your list of people that, again, see the holes, know the technology, know the market, and would understand from your perspective why this is exciting and why no one else can do this. The other proof point would be publications, academic collaborators that can really, peer-reviewed journals that can give credence to the value and the novelty of what you're doing.
Yeah, and I would say it's really about how much data you have. You might think you have enough data, but if you only have 100 patient sample, 200 patient sample, right? That's really not a validation of a diagnostic or, so there is a lot more that needs to happen. So just piggyback what Kelly said, I think, if you have subject matter experts in your advisors, that they are, whether clinicians, lab directors, that see the value, I think have them speak to the value and how they can utilize the test or the solution that you have. I think that will help the investor. But I have to tell you, we see a lot of data or a lot of pitches that come from, this is the test we're looking at this biomarker, or we're looking at this type of sort of molecular test, but the data cohort is very small. And so for us, it means there are a lot more data that needs to be generated to validate the value of that particular test. And that's sometimes why you might get a little bit of a hesitation. So
Thanks for your advice. I did reach out to those are a leader in this field. Hold on, I think I have a call coming. And they actually want to acquire the whole company, 60% or 80% of the company. And at the founders, we're excited, but at the same time, we said, no, we don't really want to just cash in a few $1 million in here and then retire. So I do have our CSO as our advisor putting on even invest in the company, sold their houses. And
yeah, that's a
actually
validation.
totally hit it. They are passionate about it. They said, Phong, none of us, I have a silent intent when I enjoy. None of us can get out until we get to phase 2 successfully and commitment. So that's things that's very difficult. And then our competitor, we went to them and they said, well, let's go promote this. And I told one of our competitor, we don't want you to fail, because if you fail, it kind of give us a bad name. We could help you achieve your successful. But they said, well, the only 2 deals, we're going to acquire you, or you help me, but I would not promote you because you're taking over my market. So I think, and that's a good thing that we have something that I've been pushing our team just to getting non-dilute funding from the deal right now. We have a couple of big grants are coming in. So hopefully that will get us a proof point that you mentioned earlier. and then show up our technology. Obviously, people show up and said, "Oh, I want this and this," and you offer liver and lung cancer, but I want colorectal cancer. And we can't just keep chasing a different therapeutic area. So I think we just gonna have to show up our technology. It's just a matter of time, but I think thanks again for advice and appreciate it.
I think Paul has a question.
Yes, thank you. Hi, Paul Strasma. I was a founder of Capillary Biomedical, a TCA company that exited in 2022. And had a question for Kelly. With this rise of the venture studio model, how should entrepreneurs think about the funding syndicate that you pull together, since you're serving as both an investor and as fractional executives in the company itself? So you're both putting capital in and you're also taking capital out.
Yes, yes. So Paul and Vikram thought about that as they were structuring General Inception. So I think, again, we have an unusual sort of style. We do typically a $400,000 investment. It's common, not preferred shares, because we wanted to, we think of ourselves as a co-founder. We wanted to align with the co-founder. And then we don't invest on follow-on rounds, and that's by design, because all of a sudden when you're starting to raise that seed round, we don't want to be on the opposite side of the table. And so again, this is where we make our investment and then we're in the same boat as you. And so we only get paid out if this is a big success and money comes back to you in 7 to 10 years, because the company was a huge hit. So we're very aligned with the founder. That being said, as we also can do slightly later stage, still pre-seed, but come in on safe or convertible notes and get into the preferred stack. And we can do both types of deals, but we won't invest in syndicated seed rounds, because we don't want to, we're not a venture capital firm. Like, that's for our venture capital partners to do. We want to exist squarely in the pre-seed stage.
So would you and TCA ever invest in a deal together at a particular stage?
That's a great question.
Yes. I just learned a lot about.
Want to know.
Yeah, I just learned a lot about General Inception, so I have plans to email Kelly right after this meeting.
I mean, if a company has friends and family or angel investors or safes on their cap table, that's great. Like, we can still invest at that stage. Where it gets a little bit trickier and like outside of our strategy is if they've already done a priced round or a syndicated round. And so some angel groups will invest on a safe, and others prefer syndicated rounds.
Okay.
What do you prefer?
That's helpful. So you would describe it as you'll come into a pre-seed deal that hasn't had a first price round.
Exactly.
Yeah.
That's super helpful.
Yeah, we do safes and convertible. So